Hello students, I hope you are studying very well and the preparation is going in full swing. There is not much time left and this particular paper that was given as the full length mock test paper, you have, I hope that you have scored well. Don't worry about me, it's the same person but uh, with a new feature, a new model of iPhone you can say. Alright, anyways, so let's start discussing these answers. And it is a very wonderful paper, learning many of the exam questions and very similar questions are repeatedly asked in the actual examination. So these questions you have to repeat again and again and again. And as I've told you, you don't have to refer any other material. Whatever I've given you as class notes, that's more than enough, more than sufficient. You don't require to look anywhere else. You read those same notes again and again. All right, and I hope you have received the quick revision notes as well. All right, so let's begin. So first question, an example of positive economic analysis would be positive economic. I told you positive pragmatic, there is a cause and effect relation and there is no opinion but it's only a fact. When you say anything with regard to a fact, it's a positive statement. You are not giving any opinion. You say when the price increases, quantity demanded decreases, nobody is going to doubt to you, all right, or nobody is going to question you. So that becomes a positive or a pragmatic statement. But the moment you start giving opinion, what should be done, what ought to be done, what should be needed to done for the welfare of the people and so on, then it becomes a normative statement. So let's see. An example of positive economic analysis would be an analysis of the relationship between price of goods and quantity purchased. Obviously, there is a relationship between price and how many units you are going to purchase. So any analysis between the same is a pragmatic statement, not a normative statement. Not a normative statement. All right. So here A would become your answer. Just hold on. Let me change. Why other options are wrong? Determining how much income each person should be guaranteed. Now what should be, how much should be guaranteed? Somebody will say this many rupees, somebody will say they should not be given anything. There can be opinion about that. Alright, there is no law to state how much guarantee a government should give to the poor people as subsidy. So this is not the answer. This becomes normative. Determining fair price. What is fair price? There is no definition of fair. For somebody fair is free, for somebody fair is the lowest possible price. So again, a normative one. Deciding how to distribute the output of the economy. How, when you're talking about it, means you are open for suggestion. Any suggestion, any kind of opinion, it becomes a normative again. So that's why only option A is the answer. Let's move on to question number 2. An economic which an economy which uses all its resources on the production of dash goods only cannot provide for the future growth prospects. So remember, any economy which produces more capital goods gets the potential of meeting the demand of the people in future. When I produce more industrial items, more capital goods, those capital goods are also known as producer goods that will help us produce some more and more of consumer goods. But when you produce only consumer goods, when you import any more consumer goods, you are not, uh, doing good for the future of the economy. All right. So obviously the answer should be capital goods. Consumer goods only, no. Both A and B has to be no. So only option A. Now here they have given you a table. They've asked you they've given you number of units, total utility and marginal utility. Remember, marginal utility and total utility relationship is that total utility is the summation of marginal utility, as simple as that. All right, so let's go through it. So if suppose for example, if I have to do calculate marginal utility here it's 0, here it will be 36 minus 0, that will be 3600, here it will be 68 minus 3600, that way it will go on. So what is the marginal utility when consumption increases from 4 to 5? It means they're talking about this point from 4 to 5. That will be 14,000 minus 12,000. That will be 2,000 should be your answer. So 14 minus 2. So marginal utility will be 2000 here. If I have to calculate marginal utility at this place as fourth unit of output, that will be 12,000 minus 9,600. That will be 3,300. All right. Next question. What is the marginal utility when consumption increases from 6 to 7 units. Alright, 6 to 7. It means now they are talking about this one. So that will be 1600 minus 800, 16,800 minus 15,600. That will be your option B. 1200 will be your answer. Next, what is the marginal utility when consumption increases from 6 to 7? Sorry, is it a repetitive question or what? 6 to 7 we have done. Okay, fifth one. Fourth one is B. What is the marginal utility when consumption increases from 8 to 9 units? Same way, 18,000 minus 17,600. Alright, so how much that will be? That will be your option 3,400. Obviously 400 will be your option here. So if I have to calculate from here to here, 17,600 minus 16,800, that will be 200 plus 600, 800 it will be here. But here it's 400. So that will be your answer, option B. Next, these are all very easy questions. I expect that you would have scored at least 80 in this paper. Which of the following statement best describes the income effect? So income effect is the relationship between the price of one commodity and how person changes the demand quantity demanded of that commodity if its own price or the price of some other commodity change. Clear? So price effect is equals to income effect plus substitution effect. So let's see what option they have given. It is the change in quantity demanded as a result of change in income keeping other things constant. No, it happens due to change in the price. It is the change in quantity demanded of substitutes as a result of change in the price of product keeping the income constant. No, it is the change in demand of a product as a result of change in the real income because of change in the price of the product. Here they've said price of the product. Yes, because I've told you law of demand, why the demand curve slows downward. Because if there is an increase in the price of any commodity, it will decrease the real income of the consumer. When this pen was available at 100 rupees, now it's available at 120 rupees. It means if I have to purchase this pen, I'll be poorer by 20 rupees. It means I will try to find a substitute which is still available at lower than 120 rupees, and that will force me to substitute this particular pen with another pen which is relatively available at a lower price. Clear? Because everybody wants to protect their income. So an increase in price will lead to decrease in purchasing power or decrease in the real income of the consumer, and a decrease in price will lead to increase in the real income of the consumer. Alright, so that will be option C. Option D is wrong. It is the change in the price of a good because of rise or fall in the real income of the consumer. No, rise or fall in the price. Remember, price. Income effect, don't talk about income, you talk about price, because the concept of income effect is derived from the law of demand. Question number 7. If the demand of a commodity is dash, entire burden of indirect tax will fall on the consumer. The answer will be perfectly inelastic. Why? When the demand is perfectly inelastic, it means if say the commodity was available at rupees 10 and I was buying 20 units, quantity I was buying 20 units. Now government increases tax, GST government increases. Now the same commodity is available at rupees 12. Government says I'll take extra tax, I'll take more tax. Now the seller, since I have perfectly inelastic demand, sellers will pass on the entire burden on the consumer. Why? Because they know that even if I pass the entire burden on to you, you will continue to demand the same commodity. Continue to demand the same commodity because you have perfectly inelastic demand. So it means when the price is rupees 12, 2 rupees increases due to indirect taxes, still I am buying 20 units. So here my total expenditure was rupees 200 and here my total expenditure is 240. Alright, so it means this 40 rupees of additional burden has fallen on me. Had it been so that the demand was inelastic, then I would have decreased the consumption. It means some of the burden in terms of missed out sales would have fallen on the seller. So that's why option B. Question number 8. Now you have to refer this diagram. Now remember, shifting of the supply curve, it happens due to factors other than price. Yeah, after the shifting of the supply curve, the price may change, but the supply curve or the demand curve is shifting right or left. It doesn't happen due to the change in the price of some same commodity. It happens due to change in factors other than price. Other than price, it could be, change in the price of related goods, change in technology, changes in cost of production. It could be anything. Clear? So first question, movement from S0 to S1, S0 to S1, rightward shift in the supply or the demand curve leads to increase in supply. We will call it as increase or decrease in supply. Here it is increase in supply. Leftward shift decrease in supply, rightward shift increase in supply, but I'll not call it as change in quantity supplied. Quantity supplied phrase is used only when there is a change, initial change in the price, and due to which there is a change in quantity supplied. It means you're moving up or down along the same supply curve. Alright, this I'll call it as quantity supplied because you're moving along the same slope. But here the slope is changing. So contraction in supply, no. Expansion in supply, no. Decrease in supply from S0 to S1, they have said, I'm sorry, not S1 to S0. S0 to S1, it means leftward shift, decrease in supply. Here will be answer. Alright. Then next question is 9. Movement from S0 to S1, I'm sorry, S0 to S1, again the same thing. Due to what? It happens due to factors other than price. Tax, if tax increases, there will be leftward shift in the supply curve. Correct, obviously. Increase in cost of production, yes, it will decrease the profitability of the sellers. So sellers will try to produce and sell those commodities which can be produced at a relatively lower price. I explained this, remember, when I started supply curve. You go and refer those 6-7 points that I made you write the arrow the way I've written it. So increase in cost of production, this is also correct. Decrease in subsidy, when government withdraws subsidy, it means the consumer will be sold at a higher price, demand will fall down. So when a demand is falling down, sellers will have to decrease the supply. This is also correct. So any or all of the above. D will be your answer here. Then question number 10. Reduction in the price of related commodities. Reduction in the price of related commodities. A and B was sold. A was sold at rupees 10, B was sold at rupees, say, 12. Now the price of B decreases. If I'm a seller, I can sell both. I will sell more of B and less of A. Why? Assuming again the cost of production is same, all other factors have to remain constant only. You will try to answer the question from the perspective of what they have asked here. They're saying reduction in the price of related goods. It means all other factors are remaining constant. Only there is a change in the price of related goods. So B here. Now suppose I'm selling B because B gives me more profit. If suppose the cost of production is 5 for both the commodities, A will give me 5 rupees of profit, B will give me 7 rupees of profit. Now what happens? Reduction in price. It means the market price for B decreases from 12 rupees to 8 rupees. Do you think now A gives me more profit or B gives me more profit? Obviously A will give me more profit. So what I'll do, I will increase the supply of A and decrease the supply of B. Isn't it? Now the supply of A is increasing. Why? Is it due to change in the price, in its own price? No, it is due to fall in the price of B. Clear? So 10 number, movement from, let's see, S0 to S1. Yes, if the price of B, if there is a reduction in the price of related commodities, if the price of B decreases, then the supply of A will increase. If the price of A decreases, then the price supply of B will increase. So movement from S0 to S2 will be your answer. S0 to S2, you see, supply will increase. Why? They have said reduction in the price of related goods. It means if now if you say, let's take it A and B, A is sold at 10 rupees, B is sold at 8 rupees. Now I will be supplying A. Now if suppose what happens, price of B further fall down from 8 rupees to 6 rupees. Don't you think those suppliers who are supplying B, they will prefer to supply A because A gives more profit? So supply curve for A will shift to the right. So S0 to S2. Question number 11. If the demand for a commodity is perfectly inelastic, it means E is equals to 0. An increase in supply will result in, so perfectly inelastic. demand for a commodity is perfectly inelastic. So this is the demand curve and this is the supply curve. This is your equilibrium price and equilibrium quantity. Now they're saying increase in supply. Supply increases is the demand curve. This is the supply curve. They're saying increase in supply. It means supply curve moves to the right. Rightward shift in the supply curve. You see quantity remains same but the price decreases, no? So let's see. Decrease in both price and quantity, no. Increase in both price and quantity is not changing. So quantity wherever change they have mentioned, you strike that down. Increase in equilibrium quantity, wrong. Quantity remains same. Decrease in equilibrium price, yes. Equilibrium quantity remaining constant. So D will be your answer here. Question number 12 now. Which of the following statement regarding elasticity of demand is true? True, false, you have to keep in mind. Don't read the question wrong. If the demand for a product is inelastic, an increase in price will have positive effect on total revenue of the firm. Now remember the outlay method. I hope you remember the outlay method. Demand is inelastic, an increase in price. Let's take a look here. Demand is inelastic, E less than 1, and they are saying that the price is increasing. Now when the demand is inelastic, E less than 1, if suppose price now increases by 10%, quantity demanded will reduce by 15% or so, or 20%, anything more than 10%. So it means what happens on the consumer? On the consumer, the burden is increasing by 10%. How much of burden? Sorry, inelastic they have said. So quantity demanded will fall down by 5%. I'm sorry. Yeah. How much of burden is falling on the consumer? Burden is falling by increasing by 10% additional burden. How much the consumer is able to decrease the burden by decreasing the quantity demanded? Only by 5%. It means 5% of additional burden is there, isn't it? So don't you think here the total expenditure of the consumer expenditure increases? So when total expenditure, if consumer is spending more, then sellers will earn more. Revenue of the seller will also increase. Think it from seller's perspective. They increase the price by 10%. So it means their revenue will tend to increase by 10%. Their revenue is increasing by 10%, but the demand is falling by 5%. It means they're falling, their market share is falling by 5%. But doesn't matter. I'm gaining 10%, losing 5% of my consumer. It means net gain is positive 5%. It means my total revenue in this case is going to increase. Alright, now let's go to the question. Where is it gone? Yeah. If the demand for a product is inelastic, an increase in price will have positive effect upon the total revenue of the firm. Obviously total revenue of the firm will increase. Positive effect, negative effect in the revenue will fall. If the demand for a product is elastic, an increase in price will have positive effect on the total. No, if the demand is elastic, it means if you increase the price by 10%, I decrease my quantity demanded by 20%, you lose revenue. If the demand for a product is inelastic, an increase in price will have negative effect on the total revenue. No, just the other way around, it will have positive effect. If the demand for product is inelastic, a decrease in price will have positive effect on the total revenue. No, demand is inelastic. So if I decrease the price by 10%, quantity demanded will increase by 5%. So I'm losing out 10%, gaining 5%. It means my total net gain, net loss is 5%. No, net fall in revenue. So negative. So revenue will not be positive, it will fall, it will become negative. So option A is the only answer. Question number 13. The demand for a factor of production is said to be derived demand. Derived demand when one commodity is used to manufacture another. It becomes a factor input. Plastic used to manufacture this pen. It means plastic has a derived demand. Alright. Or you can say the pen is derived from plastic. Right, but when two commodities are perfect complements and they're simply used together, the refill in the pen and the refill, they are perfect complementary goods, They have joint demand but not derived demand. So remember the difference between derived and joint demand that have clearly stated in the notes. Alright. So the demand for factory production is to be derived demand because it is a function of profitability of an enterprise. No. It depends on the supply of complementary factors. No. It stems from the demand of final product. Yes. Final product is shirt. Demand for shirt will increase. Demand for cotton will increase. Final product is, let's say, car tires. If the demand for car will increase, demand for demand for tires will increase, demand for rubber will increase. Rubber is used to, so rubber and tire are derived demand, but car and tire have joint demand because tire is not used to manufacture car. All right, they are separately manufactured and simply used together. Absurd option. Question number 13. Option 13. Question number 14 now. When average product decreases as a result of increase in quantity of variable input, all right, average product is falling, then what happens when the average product is falling? Remember law of variable proportion. This is your TP, this is your AP, this is the MP. Now average product is falling, it means you're talking about this point when AP is above MP. All right, so MP more than AP? No. MP equals to AP? No. MP equals to AP only when AP is maximum. MP more than, sorry, this one is right, option A is right, AP more than MP. Yeah, AP is more than MP. A is wrong, A is right. MP more than AP? No. MP more than, okay, these two are same option, so please ignore it. So AP is more than MP. So remember, sometimes like I missed out when I read the first option. Generally we have a habit of writing anything in our own way, so I prefer to write AP more than MP. All right, when I went through it, I summarily seen it, so I thought it's MP more than AP. So this kind of you can say they intentionally do it because they know the psychology of the student. All right, so AP more than MP, that will be your answer, option A. Question number 15. Now here table, I've already filled up this table. They've given labor input, marginal product, total product, average product. So remember, total product is the summation of marginal product. You see 0 plus 25, 25, 25 plus 90, 65, 65 plus 120 is 65, where is it gone? Yeah, uh, 0 plus 25 is 25, 25 plus 65 is 90, 90 plus 30 is 120. All right, then 120 plus 20 is 140, 140 plus 0 is 140, 140 minus 20 is 120. All right, and total product I have told you. So if I have to calculate marginal product, that will be change in TP by change in output, change in output by change in input. All right, so change in output 25 minus 0, change in input 0 minus 1, change in output 90 minus 25, change in input 2 minus 1. In the same way, change in output here 40 minus 120, change in input, that is 4 minus 1. All right, divided by. So let's see what question they've asked. Very simple question. If labor input is 1, total output is, labor input is 1, total output is 25. How I got this 25? I've told you, multiply the average with the labor input, what you'll get is the 2TP. So 25 into 1, you've got 25 here. You simply fill in the blanks. If labor input is 2, marginal product, if labor input is 2, then marginal product will be 65. How? 90 minus 25, 90 minus 25 divided by 2 minus 1, that will be your option, will be option C. Next, 17. If labor input is 4, output per worker, it means TP they are asking you. 4. So 140 minus 120, that will be 20 divided by 4 minus 3. So answer will be 20 here. No, just hold on. There was a fourth unit. Okay. if the labor input, okay, they have asked you output per worker, and I'm really sorry. They've asked you output per worker. It means average product they have asked you. Output per worker, if they say, that will be your average product. So that will be here. Your answer will be 35, not 20, 35. If they ask you marginal product, that will be 20. Alright. The firm's output in the short run is maximum at the point. Maximum output is at the point where MP is 0, that is the point of saturation as well. So I will not consider this particular point, I'll consider this particular point. Not this one, but this one. So the answer will be 5th unit. So 18, option is C. Then 19th, when labor input is 6, marginal product is, labor input is 6, marginal product is, sorry, labor input is 6. So that will be 120 minus 140, that will be minus 20. Alright, C. At what labor input can point of saturation will be said to be in operation? Point of saturation is the point where TP is maximum. It is the same point where MP is equals to 0. So that happens at 5th unit of input. So the answer will be here 21, sorry, 20th, option C. 21st, average product curve is parallel to x-axis? No. Parallel to y-axis? No. First decreases, reaches maximum, minimum, and then increases? No, that will be average cost. It will be first increases, reaches maximum, and then decreases. You see the diagram here? Average product, AP, this is your AP, first increases, reaches maximum, and then starts to fall down. So 21st answer is D. 22nd, which of the following is correct? If marginal product is positive and falling, total product will rise at a decreasing rate. I don't get it. If marginal product is positive and falling, it is positive greater than 0 but it is falling, total product will rise at a decreasing rate. Yes. When MP starts to fall down, TP star is increasing at a diminishing rate. Or remember the three columns that I had given you. All the questions can be answered from those three short columns. Total product divided by quantity of variable factor equals average product. Yes, that is also correct. So the moment more than one option is correct, you don't have to read the third option. All of the above is given, just hit on all of the above. But anyways, let's go through it. Marginal product and average product can be calculated from total product. Yes. Alright. Change in TP divided by change in input is marginal product. TP by input will be your average product. Alright. So marginal product is change in TP, that is change in output by change in input, and average product is total output by total input, not change but total. So where is it gone? 22nd, right? This is also correct. So all of the above. D is your answer here. 23rd, why demand curve, otherwise known as average revenue curve? Because I've told you demand will only be created when there is an affordability. It means people have the ability to pay, not only willingness to buy. So MU curve and AR curve both known as the demand curve, because AR is equals to price, and price determines your ability to pay, not because it's downward sloping curve. Otherwise, every downward sloping curve, even an isocont curve, a production possibility curve, will become a demand curve. 23. Price paid for each unit by a consumer is the average revenue per unit of seller. Yes, because the relationship between price and revenue, and if the price increases, revenue will decrease if the demand is elastic. This is correct. B. Price paid for each unit by consumer is total revenue of the seller. No, that's not total revenue, that's every average revenue. Price paid by consumer is equal to seller's willingness to sell. No. So obviously A will be your answer. 24. Since consumers continue buying till the price equals marginal utility, if the price of a product is lower, the consumer will attain equilibrium obviously at a higher quantity level, no? Because consumer surplus is what? My willingness to pay and my ability to pay. My willingness to pay is 20 rupees and the price is available at and the quantity good is available at 18 rupees. So I can buy till the price becomes equals to 20. The moment price goes beyond 20, I'll not be able to pay. I'll not buy. But if suppose the price again decreases to 15, don't you think I'll be able to buy more number of units? It means I will achieve satisfaction at a higher level. You wanted to buy one phone because you can afford one phone. If the price of phones fall down, you can buy two phones. So don't you think you will achieve equilibrium at a higher level? All right. So the at a higher level of consumption, zero quantity level equilibrium will never be achieved. No. Question number 25. Suppose consumer taste shift towards consumption of apples. Alright. Which of the following statement is accurate description of the impact of this event on the market for apples? There is an increase in the quantity demanded of apples and the supply of apples? No. If my taste is shifting towards consuming more apple, it means this event is happening due to not price, due to factors other than price. Alright. So they have used quantity demanded. So that's why wrong. There is an increase in quantity demanded. Again, quantity demanded happened due to change in price. Preference is shifted. My preference have shifted. They have not mentioned price in the question. So nowhere you will mark quantity demanded. There is an increase in the demand for apples and decrease in the supply. If the demand for apple is increasing, why the suppliers will not supply more apple? So no. There is an increase in the demand for apples and increase in the quantity supplied. Yes. Because if there is an increase in the demand for apple, it means the sellers can increase the price, and when the price increases they will increase supply. Now this question, they have taken apple, they should not have taken apple into consideration. Why? Because the supply of perishable commodity cannot be increased in the short run. They should have taken something else. But going by the flow of the question, question number answer is D. All right. So question number 26. Which of the following is an assumption under cardinal approach of utility analysis? Cardinal approach, something that can be measured and quantified. Ordinal, which can be ranked but never quantified. So measurability of utility in monetary terms. Yes. How much of utility I am getting when I am spending X amount of money, that is cardinal. It means how much of money, I mean, is the good worth it, and that's how we can measure the concept of consumer surplus. Alright, then this concept of cardinal approach was given by Alfred Marshall, ordinal by Hicks and Allen. Under ordinal approach, we study about indifference analysis. Change in marginal utility of money? No. Utility rises even at zero consumption? No. When there is zero consumption, both TU and MU will be zero. So option A is the answer. Next, question number 27. Total utility derived by Ram by eating 6 apples is 300. TU for 6th apple is 300. Marginal utility achieved or derived from the 7th apple is 30. So I've told you TU is nothing but the summation of MU. So that will be 30, 300 plus 30, that answer will be 330. Simple question. Next, the further is the indifference curve, the further the indifference curve is from the origin, then obviously higher indifference curve or any indifference curve which lies on a higher slope will give more satisfaction to the consumer. So as we move from a lower to a higher indifference curve, satisfaction increases, and we move from a higher to a lower one, satisfaction decreases. The higher is the satisfaction level, so that will be the answer. Lower, no. Same satisfaction, no. All right. So this concept I think you all remember. So next, question number 29. What will be the marginal utility? Now this table they have given for this particular question. What will be the marginal utility of X if the price of X and Y are rupees 10 and 20? So price of X and Y is 10 and 20 respectively, and the marginal utility of Y is 50. Marginal mu for y is 50. So you have to find out what is the marginal utility of x. So I've told you, apply the formula mu of x by mu of y equals to px by py, as simple as that. So they've given marginal utility of x and y, price of x and y they've given 10 and 20, and the marginal utility of y is 50. They've given here is 50. So mu of x will be 50 into 10, that will be 500, and 500 divided by 20, that will be 25. Simple again. Now table is given for the next question. You are given the following data. So what they've said, output they've given TP and they've given factor, that is input and output. This is your input and output. The above data is an example of, you see, if the input is increasing by 1, output is increasing by 15. So if I have to calculate the marginal product, so that will be 0 here, 15 here, 35 minus 15, that will be 20 here, then it will be 25 here, then it will be 60 plus 90, 32 here, it will be 8 plus 40, 48 here. It means marginal product is increasing. So when TP is increasing at an increasing rate, it means marginal product is increasing. It means what you're getting is increasing returns to scale. So answer would be option C. Question number 30, option C. Next, given following, again they've given input and output. Above data is an example. If I have to calculate marginal product, here 0, here 15, here 15, here 15, again 15, again 15. MP is constant, alright, because TP is increasing at a constant rate. So in this case what you're getting is a constant returns to scale. 31, answer is A. Next, 32. Manufacturer can lower their cost by producing a variety of different products on the same equipment. Okay, the added volume helps in lowering average total cost. Yes, if you produce more, average total cost will decrease, right, because you are allocating the cost of the same machinery over a large number of units of output. It may also allow firm to employ different types of equipment and have lower variable cost. This will lead to obviously production efficiency. This is nothing but an example of increasing economies to scale. So it is economies of scale. Internal economies part of, obviously. So production of economies of scale, law of returns to factor, law of diminishing marginal return, no. Economies of scale. 33. A producer can produce using two inputs combination of A and B. So A and B, let's take it. A and B. A takes 2 units of labor and 8 units of capital. This is labor, this is capital. A takes 2 units of labor and 8 units of capital. B takes 3 units of labor and 5 units of capital. What is the marginal rate of technical substitution for capital? You see, if you increase the labor by 1 unit, if you increase the labor, you can decrease your capital cost by 3 units. So the answer will be 3 units of capital can be substituted by 1 unit of labor. So the marginal rate of technical substitution between labor and capital is 3. Easy. Question number 34. Which of the following is true regarding economic cost and accounting costs? Remember, economic cost is the addition of both accounting cost and non-accounting, that is explicit cost and implicit cost. Alright. So Economic cost is equals to accounting cost. It will only be equal to accounting cost when there is no implicit cost, otherwise no. Economic cost is more than accounting cost, yes, because economic cost also includes implicit cost or non-accounting cost, which is not present in accounting cost. So this is correct. Economic cost less than accounting cost, no. Economic cost excludes opportunity cost, no, it includes opportunity cost, because opportunity cost is implicit cost. So implicit cost is also known as opportunity cost, alternative cost, non-cash cost, right? Non-accounting cost. 25. When total revenue equals economic cost, it means there is zero economic profit. And remember, zero economic profit means normal accounting profit. Remember the numerical examples I had given you. So has no profit and loss, no. Earns normal profit, yes. Earns more than normal profit, no. Incurs losses, no. Easy. Marginal cost curve of a firm will show behavior when compared to marginal product. See, cost and product, when I'm talking about cost and output, all right, marginal product is what you're getting is the additional output from one unit increase in input. All right, how many extra output you are able to derive from an addition of one input. Clear? So marginal cost of a firm behavior when compared with marginal product, they have reverse relationship, because marginal product curve moves like this and marginal cost curve moves like this. Clear? Which of the following statement regarding output is false? False, you have to find out. Output is under the control of the firm. Yes, obviously this is true, so this is not the answer. Magnitude of output means how much is the quantity of output determine the total cost of production. Yes, this is also correct. More output, more cost, less output, less cost. Change in output level determine the rate of change in total cost of production. Yes, this is also correct. How much your total cost is changing will be determined by how much your output is changing. Output has no role to play in determining the cost function. No. Output cost is dependent on output. So this is wrong. This is false. So this is your answer, option D. A, B, C are correct, D is false. So you have to choose the wrong or the false option. Question number 38. TC curve will commence from, total cost curve will commence from where? Remember, TC is the summation between total variable cost plus total fixed cost. When output is 0, total variable cost will be 0, but total fixed cost will not be 0. So it means the TC curve will start from the same point where the TFC curve starts. Clear? So the answer will be from a point along the y-axis. So answer will be option B. Cost chapter is very, very important. Remember, students. Question number 39. The relationship between AC and MC is that MC will always be less than AC. No, you see, this is AC and this is MC. Here AC is higher than MC, here AC is lower than MC. So this is wrong. MC will be more than AC when MC is falling. MC is falling and you see MC will be more than AC. MC is falling. Is MC more than AC? You see, no. So this is also wrong. AC may be more than MC. MC may be more than AC. Sorry, AC will maybe more than MC when MC is rising. Yes, you see, MC here it's rising. MC here it's rising, no, and MC is also more than AC. So option C may be correct. Question number 40. Question number 40. As quantity increases, total revenue curve, remember total revenue curve, quantity when you are increasing, TR increases, reaches its maximum point and falls down. Go to the unit where I have explained the relationship between TR, MR and AR. So when the demand is elastic, alright, When the demand is elastic, a small fall in price will lead to more increase in total revenue. E more than 1, here E equals to 1 and E less than 1. Alright. So always increases no, always decreases no, first increases, reaches maximum and then decreases. Correct. Decreases first, no. If total revenue decreases first, then nobody will produce ever. A rational person does not act unless. Rational person is always logical. He will always do a cost and benefit analysis. Is it worth it? Is it worth my money? Then I'll do it. I will not guide it by emotion or any other factor. So action is ethical? No. Ethical or unethical, that's a different thing. Here in economics we talk about cost and benefit. Action leads to marginal cost exceed marginal revenue. No, this is illogical. If the cost is more than benefit, I will not incur that cost. A company will never start a business if the cost is more than the revenue that they will generate. Yes, momentarily it can be a possibility, but in the long run they will expect to earn more revenue from every unit they are sold, which are sold. The action produces marginal benefit which exceeds marginal cost. Yes, option C is correct. Action makes money for the person. Every action that makes money is not a rational action. Alright. Next, because even I can make money wherein I'm selling some commodity at a very low price that doesn't cover my cost. So I'm getting money, but that money is not going to help me cover my cost. So that cost is more than benefit. I'm receiving benefit, I'm receiving money, but it's less than the cost that I've incurred. If two goods were perfect substitutes, right, each other, it means that the indifference curve relating to the two goods will have a positive slope or a negative slope. Tell me, what will be your answer? Will be linear. Alright, remember, indifference curve is just like this, but when two commodities are perfect substitute, they can be infinitely substituted. So indifference curve will become simply a downward sloping curve, so it will be linear. Next, if consumers expect an increase in price of a product in future, if something is sold at rupees 10 and in future I expect the price to increase to rupees 15, what will I do? I will demand more at this time, because I know if I wait the price will increase and it will lead to decrease in my real income. So the answer will be its current demand will increase. If you come to know that the price of petrol is increasing from tomorrow, then you will buy more petrol today at a lower price. So the demand will be higher. Question number 43. So now question number 44. Under total outlay method, if the price and consumers total expenditure on the product move in the same direction, then price elasticity of demand is, let's say if the demand is inelastic, E less than 1. So long. If the demand is inelastic, that is E less than 1. In that case, I have to decrease the width of the pen. Right. So in this case, if suppose price increases, let's say by 10%, quantity demanded will decrease, let's say by 5%. That's how E is less than 1. Percentage change in quantity demanded is lesser than percentage change in price. So it means, you see here price is increasing by 10%. It means what will be the burden on me? The burden on me will be 10%, correct? So what I'll do, I will decrease my consumption by 5%, but I'm decreasing only by 5%. It means 5% burden is still remaining on me. Had it been the case wherein there is an increase in price by 10% and decrease my consumption by 10%, it means the burden increase was 10%, I decreased my burden by 10%. It means I am burdened in the same way. It means I am neither spending more money nor less money. But here the burden that is falling on me due to increase in price is 10%, but I'm able to shed off this burden by only 5% through decrease in quantity demanded. It means 5% of burden still there on me. So it means what will happen? Total expenditure will increase. So what has happened? Price increased and total expenditure increased. They move in the same direction. So it will be the case wherein E will be less than unity, so inelastic demand, option C. Next, in case of unequal distribution of income, it means there will be big gap between rich and poor. The propensity to consume, it means how frequently you are consuming. Are you consuming fast? If you're consuming fast, you're consuming more. Alright, for example, people who are living in urban India, their propensity to consume is more because on and off they keep shopping, you see online shopping, this and that, so many things. Every year they change their mobile phones, every weekend they have pizzas, or every weekend they go for a movie. So consumption is more. Why? Because the income is more. But if there is more inequality of income, if you go to rural India, the propensity to consume decreases significantly because a majority segment of the people there are poor. Majority of segment of the people are poor. So their consumption will be lower. So propensity to consume will be lower and the demand for consumer goods will also be lower. You see the number of televisions and mobile phones and every commodity that is sold, whether durable goods, non-durable goods, consumer goods, in urban India is way significantly higher compared to rural India. Alright, when you're talking about in percentage terms. So both lower and lower, that is option D. These are basic concepts question that you can answer even though you don't know anything about economics. You cannot go wrong on these questions. Question number 46. In case of returns to factor, rational producer will not operate in stage 1 due to the reason that, see, in stage 1 your TP is increasing at an increasing rate and marginal product is also increasing. But why will I not stop producing at this point? Because in the second stage what happens, the TP is increasing but at a diminishing rate. So it is growing but at a diminishing rate, it is not falling down. So if I stop at stage 1, I will not be able to utilize the full potential of the fixed resources that I put in my business. And since I'm not able to utilize the full potential of the fixed inputs, I'll also not be able to use the full potential of variable inputs. So it means if I stop at stage 1, despite the fact my productivity is increasing at a very fast rate, I will be underutilizing my resources. So that's why I will not stop at stage 1. I will not go beyond stage 2. Why? Because beyond stage 2 you are putting in more variable inputs compared to the optimal capacity of the fixed input. It will lead to wastage and TP will start to come down. So you will operate at stage 2 and also at the point wherein TP is maximum. So let's see 46. So in case of law of returns to factor, a rational producer will not operate in stage 1 due to the reason that there is more scope for making the best use of fixed factors. Yes, that's correct. Let's go to other options. Total output still shows an increasing trend. Yes. Optimal combination of fixed and variable factors is not yet achieved. It will be achieved at the point wherein TP is maximum. This is also correct. So all of the above. Question number 47. Law of diminishing return is not relevant when all labors are equally efficient. No, it is relevant. The time period is short, yet it's a short run factor. Why? Because they have not used the word scale. If they don't use the word scale, it means it's a short run production function. You can call it returns to factor, law of diminishing marginal return, or law of variable proportion. The time period is short. This is also correct. They've asked you is not relevant. Wrong. The factory inputs are not factory input but factor inputs are increased in the same proportion. No, when you're saying same proportion, it means you're talking about the law of variable proportion, because in the short run when you're talking about proportion, there is a variable proportion, not a same proportion. It means you only keep the fixed input as constant and go on increasing the variable input, but in the long run you change the fixed input as well. So there is no distinction made between the fixed and the variable, so same proportion. So this is pertaining to long run. The question was related to short run, so this is not relevant. So option C is relevant to the long run, not the short run. Technology remains constant. Now technology is assumed to remain constant both in the short run and in the long run. This is given you just to confuse. A very good option. Technology is assumed to remain constant both in the short run and in the long run production function. So when they ask you long run or short run, this option will not hold any value. Why? Because it is common to both short run and long run. Alright. So option C is your answer. Question number 48. Which of the following statement regarding long run cost function is not true? Not true. So let's say the firm adjusts factors of production to meet the market demand. Yes, this is true. You can adjust the factors inputs to meet the demand. If the demand increases, you produce more, but demand decreases, you produce less. Firm identify a combination that gives maximum output at lowest cost. Now that's the that's the concern for every producer. That remember in the I've told you when I explained production function is that a producer will always try to get or maximize his output. He will try to bring down his cost to the lowest possible point. Alright, he can do many things for that. He can produce in large scale, so he can allocate the cost of fixed input over a large number of output. Alright, so not true bola, this is also correct. Inputs are chosen for producing a desired level of output. Yes. All inputs in the long run are fixed. Wrong. Every factor input in the long run becomes variable. So this is your answer because this is not true. Question number 49. A manager needs a stenographer and a clerk for the account department. But due to financial constraint, he can be able to recruit only one, either stenographer or clerk. Finally, he decides to recruit the stenographer and had to give up the idea of having an additional clerk in the account department. Here the cost of not hiring an accountant clerk is known as opportunity cost. Why? Because he is not able to employ also a clerk. The opportunity cost will be in terms of delay in work being done. Alright, so that will be your opportunity cost. Opportunity cost not necessarily be in monetary terms, also it will be in terms of the lost opportunity that you could have made had you been in a position to appoint also the clerk. So option C is your answer. Which of the following describe the behavior of average fixed cost? Average fixed cost is a downward sloping. It is not a straight line, but it will continue to fall down with the increase in the level of output. Why? Because the same amount of total fixed cost is divided by higher number of output. It means numerator is same but denominator is increasing as the output is increasing. So it will continue to go on falling, but it will never become zero. Why? Because even if I am producing 1 million unit and the cost is 1 lakh rupees, you will get the decimal figure. Alright, if you are producing 1 million unit and the fixed cost is say 20,000 or 1 lakh rupees, you will get a decimal figure, you will get negligible figure, but it will be not zero. Alright, so let's go through the option. Remains constant throughout the level of output. No, total fixed cost remain constant, not a average fixed cost. Declines throughout as the output increases. Absolutely correct. So option B will be your answer, but let's hold on, let's go to the other option. Declines first, reaches its minimum point and then rises. No, that happens to average variable cost and average total cost and average marginal cost. Rises first, reaches maximum and then declines. No, so option B. 51. Let marginal cost MC and marginal revenue MR. If MC curve cuts MR from below, so this is your MR and this is your MC. In case of perfect competition, this is your MR and this is your MC. So let's see. MC has a negative slope? No. MC cuts MR when it's rising up. When something is rising, its slope is not negative, it is positive. Clear? So wrong. MC curve has a positive slope? Yes. MC curve is parallel to x-axis or y-axis? Absolutely not. Next, question number 52. So please remember the diagrams are very important and you have to practice the diagram, because in the questions, as you've seen, more often than not, it means very rarely you will get a diagram and they will give you the diagram and ask the question. Mostly they will ask you the question without giving the diagram. So if you don't have that concept or the diagram in your head, you will not be able to answer the question properly. So whenever you're solving question, I've told you again and again, keep a blank sheet of paper by your side and roughly draw the diagram. All right, clear? Next, question number 52. In economics, prediction about the behavior of variables in future is never possible? No. If some change is going to happen in future, I may be able to predict it. I may not be absolutely true, correct, or absolutely false, absolutely incorrect. But to say it's never possible, it's incorrect, because otherwise demand forecasting will never be a possibility. Is possible but may not be always accurate? Yes. Just like weather forecasting. Can I say weather forecasting is always inaccurate or always correct? No, both statements are wrong. So sometimes it's correct, sometimes it's inaccurate. All right, clear? So option B is possible with 100% accuracy. Nothing is possible with 100% accuracy. So option B is your answer here. Clear? Question number 53. 53. Decrease in demand is greater than decrease in supply. So decrease in demand is greater than decrease. They have used the word decrease. So let's draw the diagram. This is supply, this is demand, this is equilibrium price, this is equilibrium quantity. Now demand is decreasing. They have said decrease in demand is greater than decrease in supply. So demand, let's say demand shifts to the left. Let's decrease the demand by this margin, DD1, and decrease in supply, let's decrease it by this margin, SS1. So where the new demand curve and supply curve intersect? Here at this point. So what happens here? The quantity decreases and the price also decreases. Both decrease. So price increases, quantity decreases? No. Price decreases and quantity also decreases? Yes. Quantity decreases but price remains unchanged? Again, price decreases, quantity remains unchanged? No. So option B is correct only. 54. Remember the 13-14 situations that we have covered already? So it's very, very important. In which of the following market conditions does firm maximize its profit when its marginal revenue is equal to marginal cost? I've told you the concept MR equals to MC will hold true in every kind of competition, whether it's perfect competition, whether it's monopolistic, oligopoly or oligopolistic, or you can talk about any other form of competition, perfect, monopolistic, monopoly or oligopoly, monopsony or whatever. So because you see the golden rule of accountancy is not going to change because you're changing the accounting of from a partnership firm to a company. The conservative principles, the materiality principles, it remains the same. So all of the above. Question 55. Which of the following is not a characteristic feature common to both monopolistic competition and perfect? Not, they've asked you. Many buyers and sellers, it is common. Identical products? No. In case of perfect competition, the products are identical. In case of monopolistic competition, the products are similar but not identical. Very similar substitutes will be sold but non-identical goods. For example, a mobile phone industry is a monopolistic market. Why? Because Samsung, Nokia, LG, you have Apple, so many different phones. They are very similar to one another, very similar feature, but they are not identical. Alright. And perfect competition is an ideal construct, it doesn't exist, but they ask you which market very closely you can say relate to a perfectly competitive market. It's a perishable good market or an agricultural market. Alright. Identical products, no. So this is not the characteristic, so option B is your answer. Option C, easy entry and exit, yes, this is true for both competition. Large number of small sellers, this is also true. So identical products is the difference between perfect and monopolistic competition, not the similarity. They've asked you not the common characteristic. Question number 56. Which of the following market forms will never suffer losses in the short run? Remember, every competition, whether it's monopoly, monopolistic, oligopolistic or perfect, they can incur losses and also abnormal losses. No, abnormal profit is not possible in certain competition. Perfect competition is never possible. Monopolistic competition, in the short run it could be possible, but in the long run never possible. Alright, monopoly, it can be short run or long run, it could be a possibility, but losses can happen in every business. It doesn't matter to which market it belongs to. So option is none of the above. Question number 57. If prices fall below the minimum average variable cost, it means price P is or AR is less than AVC, then you should shut down your production. Remember, production shutdown and continuation decision. P or AR equals to AVC or greater than AVC, you should continue to produce. Lesser than AVC, you should shut down the production. Produce output where MR equals to MC. Reduce, no, wrong. Reduce its output so as to increase the price and profits, no. Stop production output until the price increases, yes. Until the price increases and your price is higher than AVC, it means, or equals to AVC, it means you are actually covering your AVC. Fixed costs you are not covering, but if you shut down, still the fixed cost will be same. And if it increases beyond AVC, it means apart from your average variable cost, you are covering some part of your fixed cost. Then you should certainly produce. So here option C should stop producing, because your price is not able to cover even your average variable cost. If you shut down, if suppose the price is 100, AVC is 120 and AFC is 50, it means if total, how much is your revenue, that is per unit? 100. How much is your cost? It will be 170. If you continue to produce, you will incur losses to the extent of 70 rupees. But if you discontinue to produce, it means what will happen? Your cost will be only the fixed cost that you are not able to recover, that it will come down to 50. You should shut down production. Continue to produce in the short run, no. Option C is your answer. Question number 58. In case of profit maximizing monopolist, what point determines the selling price? I've told you I will produce at the point where MR equals to MC, that is at the point of equilibrium, because every unit I sell should recover the entire cost of the additional unit that I have produced. Point where marginal cost equals average revenue, no, marginal revenue. Point where average cost equals marginal revenue, no. Point where average cost equals average revenue, the answer will be marginal cost equals marginal revenue. MR equals to MC, profit maximizing point. Question number 59A, B, C, D. Okay, they have given A, B, C, D. I have to match the following. Rising employment and real wages, that happens during growth or expansion. So that will be expansion happens, that will be your 1, will go to recovery, no, recovery, slow expansion happens, so this will go to B, 1B. So it means 1B is here. I don't have to see anything else. I can make this one A is correct, but let's see. GDP increases but at a diminishing rate, it means there is a contraction that is happening. All right, so slow down. Remember, recession is severe contraction. All right, and after recession there is depression, that is the lowest point, negative growth. Next, fall in the level of real national output. that is obviously a recession and setting in the rising trend of national output. Alright, now the trend had started to recover, so that will be D. So 1B, 2C, 3A, 4D. So option A will be the correct answer. Next, peaks and trough of business cycle are collectively known as turning points. Alright, because if the GDP is increasing and then it's falling, this is expansion, as I've told you, this is boom or peak, this is contraction, and this is trough or depression. So this is the turning point. It means from the highest its contraction starts, from the lowest recovery starts. Alright, so they are known as collectively as turning points. That's question number 60. Alright, now remember, out of the 60 question, those who have got 50 plus, congratulations to you guys. If you got here 50 plus, then easily you can score 50 plus over there. Those who scored around 40, you need to work little. It's an average performance, but you need to work hard. And those who have got below 40, please work harder. Alright. Now, business and commercial knowledge, mostly factual questions will be there. So let's go through it. In a Hindu undivided family, the liability of whom is unlimited? The liability of Karta is unlimited. Alright. Kopasenas are liable to pay liable towards only their contribution and not much. That is one of the advantages of the Hindu undivided family, because all other members can be spared, only the Karta will be his assets can be attached by the creditors if the business is not able to meet its liability. Alright, next, in relation to business organization structure, which of the following is easy to form and wind up? Obviously, a sole proprietorship business, minimum or no legal work is done. Company, very difficult. Statutory corporation, difficult. Public enterprise, also very difficult. Next, 63. Steel Authority of India Limited is an example of public sector enterprise. Alright, public sector enterprise because it belongs to the government of India, wherein majority of the ownership lies with the government. Next, 64. None of liability of other Kopasinas are limited to extent of their share, unlimited to the extent of their, no, limited. So now here option A and D both are correct, remember, but A explains better compared to D. So I'll go with A. 65. Which of the following organization is only found in India? That will be Hindu undivided. That's an oldest form is sole proprietorship in the world, but only organization which is found in India, or it's only it's only created in India, it's Hindu undivided family business under the Hindu Succession Act. Clear? Alright, and remember the communities who are included: Jain, Parsis, Buddhist, Sikh, along with Hindus. So option A. 66. Mission statement of a company is derived from its vision statement. What is my vision? My vision will determine my mission. My vision is to make my company the number one in the world in whatever we produce. Now that's my vision. So I have to make a mission to achieve my vision. Clear? So option B. Macro factors of business environment are generally as controllable as micro factors? No. Less controllable than micro factors? Yes. In fact, macro factors are very difficult, and I remember 3 different types of organization. The dynamic ones are the ones they are powerful, they can control. Otherwise, none of the organization are as powerful to control the macro ones, because they are part of external environment, not internal environment. So less controllable than the micro ones. More controllable, no. Next, 68. There is a close dash interaction between business and its environment. Close and continuous would be a better word, not frequent. Alright, close and continuous. Frequent, it could be frequent, it means it happens on and off, on and off, and okay. It means there is a gap between the happening, but no. The business will interact with its environment on a daily basis because every day it's dealing with the consumers and every day the goods and services are sold to so many consumers. So it means it's a continuous process. So question number, now some questions you have to answer using your, applying your common sense. Next, 69. Which of the following is a part of liberalization process? It means when the economy was liberalized through 1991 economic reforms. Alright. Making industrial licensing requirement mandatory in most industry. No, when you make something mandatory, it means there is no liberty to do any business. So this is wrong. Regulating the scale of activity, it means how much I should be produced is regulated by the government. Again, this is not liberty. This is undue pressure posed upon the business by the government. So wrong. Fixing prices of goods and services. I produce something, I will determine at what price to sell. If government interferes, then it's not liberty. Again wrong. Option D, simplifying the procedures for imports and exports. So that is one of the points. Liberalization doesn't mean only simplifying procedures for imports and exports. Liberalization means removing the restrictions of the government imposed upon businesses. It could be in terms of what should I produce, how should I produce, where should I produce, at what price I should sell, right, to whom I sell, will I be able to export or not. So that is liberalization. If in any of these or all of these government does some interference, then that is not liberalization, and that was the case before the economic reforms of 1991 that took place. Next, so option D, that is just a part of liberalization. Question number 70. Which of the following factor is not included in micro environment? Customer, micro. Employees, my employees. Alright. Internal it should not be like micro, but okay, no problem. Suppliers, my suppliers, micro, but technology is for everybody. It's a part of macro environment. When there is a change in technology, for example, in the IT sector, it will affect every IT company, not only one IT company. So option D. Next, 71. Early identification of opportunities helps an enterprise to be in the first to exploit them instead of losing it to its competitors. The mentioned advantage can be categorized as obviously first mover advantage. Because you see, when online businesses started to come up, those who started the businesses first, they are the ones who are the world leaders today, whether it's Amazon, whether it's Flipkart. All other ones that they've started afterwards, they don't get the first mover advantage. Likewise, Apple has distinct advantage when it produces any mobile phone. It's a touch based phone. Why? Because the first mover advantage. I'm not saying Samsung and other companies are not catching up. They are catching up, but Apple has a distinct advantage compared to its competitors. So first mover advantage, you call it. 72. Product differentiation is an example of obviously competitive advantage. Why? Because I've told you advertisement is based upon what? To tell you that my product is better than his product. Alright. So I differentiate my product. There may not be any difference. Right? Every perfume manufacturer say that his perfume is different. And if you continue to say this to the customer, they will listen to you. Maybe once they will not listen, twice, 10 times they will not listen, but 100 times they will listen. If you keep banging on their head through the advertisement. Clear? So it will be competitive advantage, product differentiation. Because if I differentiate my product and tell you that I'm offering you a feature that nobody else offers, then automatically people will be inclined to buy my product than my competitor's product. Next, 73. Which of the following is correct? Privatization got momentum in India after 1947. No, 1947 mostly we had mixed economy, but it was more socialist, less capitalist. So no. Privatization and liberalization has no correlation. No, it has significant correlation. Without liberalization, private businesses will never be able to flourish. So wrong. Privatization facilitates liberalization. No, the other way around. Liberalization facilitates privatization. First you liberalize, then only private people will be putting in money in businesses. So wrong. Liberalization facilitates privatization. Yes. Liberty has to be there for businesses to operate privately. 74. 75, 73, 74. Change in technology, economic condition, political and legal factors are obviously external, because I cannot change my economic condition. If a business is there, as a businessman, can I change? No. Can I change the who is running my country? No. Can I change the technology adopted by the economy? No. So these are all external to the business environment. Next, 75. Following is not an objective of privatization. Not. Improving performance of PSUs, this is an objective. PSU, public sector undertaking, it means government ownership is there. When government privatizes, the purpose is not to just sell it off, purpose is to give it to those who operate it at a profit, so that government tax revenue can increase. It can increase employment, it can promote GDP growth. Decrease in the size of the private sector, no. Objective of privatization is to increase the size of the private sector, not decrease it. So this is wrong, so you have to choose the wrong option. So option B is the wrong, so you have, this is the option to choose. Reducing administrative burden, yes, when government is controlling everything, the burden on the government will be immense. When government privatizes, government says, okay, you go and take control of it. Revenue generation, obviously, when private people who are taking over the businesses of the government, they will try to run it at a profit, because they are going to run it on a rational basis, applying the concept of cost and benefit. Next, 76. So option B is the answer, which is wrong, because you have to choose which one is not. GDP per capital income, per capita income. Per capita income, foreign exchange are examples of obviously economic conditions. Alright, at what rate I am growing, what is my per capita income, it means total national income divided by total population, what is the standard of living. Foreign exchange, it means how much foreign currencies are we earning through exports, and so on. These are all economic conditions. If government wants to promote these, government will have to make a policy, then it becomes an economic policy. But they've asked you not the changes or the laws made into it. If they ask you the provisions made by the government to affect a positive change in GDP, per capita income, and liberalize the use of foreign exchange, then it will be a part of economic policy. But here they have asked you, what are these? These are conditions. It could be bad or good. In our country, it's going bad. Dash means transferring something from state ownership to private ownership. State ownership, it means government ownership, not state government, but government ownership. To private, it means government is selling off partially or completely the asset ownership of assets to the private sector. Alright, so that will be privatization. Option B. 77, 78 now. Adani, now these are all factual questions. Adani headquarters, names of CEOs and CFOs, and sometimes the mission statement they also ask, but largely CEOs and CFOs name and headquarters you have to keep in mind, and summarily go through it, because not more than 2 questions will be asked from here. So don't bang your head over it that I'm not able to remember. Don't try to cram. Just before you go to bed, flip through the pages so that you can read about these companies, and if you want, you can leave the foreign firms. You can focus on the Indian firms only. Adani Group has its headquarters Gujarat. Asian Paints was initially set up as a partnership firm. Axis Bank was established in 1993. Before Axis Bank, it was known as UTI Bank, which was a public sector undertaking under the ownership of Government of India, which was privatized, and it became from UTI Bank to Axis Bank. Next, Bajaj Group was established by Jamunalal Bajaj. He was a great nationalist and he funded the Indian national movement as well. Next, Bharti Group was established by, now in your answer key, this is wrongly given as Sushil Mittal. It's not Sushil Mittal, it's Sunil Mittal. So 82 is B, Sunil Mittal. Please rectify that. 83, which of the bank provide digital services? Pay Zap. Obviously, Pay Zap is provided by, I think it's HDFC Bank. I've been using it. My wife has been using it. Yes. 85. Sorry. 84. What is the global banking platform edge verb system Infosys called Pinnacle. Public policies are always dash oriented. Every policy is goal oriented because without a goal or an objective, a policy will be useless. 86. Policies curtail all benefits in some or particular issue. Any policy that tries to restrict some activity is a restrictive policy. Any policy that tries to promote something, that is facilitating economic policy. Alright. For example, under Make in India initiative, government says I will give subsidies to the producer who are producing in India rather than importing those goods. That is a facilitative. Government giving tax breaks to startup, that is facilitative policy. Government imposing heavy excise duty on cigarettes and alcohol, that is restrictive policy. Government is banning the advertisements related to cigarettes and alcohol, that is restrictive policy. Next, dash model of government has a strong private sector, capitalist, obviously, because it's based on the concept of laissez-faire, wherein government's intention is to only manage the country and govern the country, but businesses are done by the private sector with full liberty. 88. OCB stands for Overseas Corporate Bodies. There is no explanation required for these terminologies. 89. FDI is prohibited in India. Which of the following sectors? Atomic energy is prohibited. Next, FEMA replaced FERA legislation in which year? In 1999. Next, the form of privatization where government keeps the hold of responsibility and private enterprise handles the management of it fully or partially is known as delegation. I will own the ownership. I will hold on to the ownership. I will give you only the contract to run the business, to manage the business. That is delegation. I'm delegating my work to be done by somebody else, but I'm holding the responsibility of my business. It's simply like, let's say you own a business and you put a manager and delegate to him the authority to manage the business. The manager will not end up owning the business. He is only managing the business. The ownership lies with you, right? Same case here. In case of public sector undertaking, government says you manage the business, but I will own it, right, through private partnership. 92. Dash emanates from decision, and decision is taken in line with dash to identify the right expression to fill in the blanks. Policy, budget, plan, goal. Policy emanates from decision. You take a decision in order to make a policy, and decision is taken in line with goals. What are your goals? So I want to make a policy. I have to take a decision to make in order to implement that policy. But how to implement that policy in order to achieve that goal, all right, that is also very important. So A. 93. The method of FDI other than automatic route is known as, you can call it as Foreign Investment Promotion Board, or you can call it as government route, all right. So under FIPB route, you need prior approval. You need to take permission from the government before you start investing in India, before a foreign firm starts investing in India. But under automatic route, a foreign firm can come and start its business in India, only need to inform the RBI after their arrival. Sometimes they ask you automatic route, which organization must be intimated by the foreign firm after FDI has been made. So it will be RBI, Reserve Bank of India. Next, 94. Dash is responsible for monetization of economy in India. Obviously RBI, because RBI is the sole authority to print currencies in India, and by increasing the supply of new currencies, you will monetize after demonetization. That has been simply a disaster. 95. The rate at which banks borrow money from RBI against pledging of government securities is known as repo rate. You pledge government securities and borrow from, I've told you, buying and selling of securities nothing but comes under the repos. Which of the following institution protect businesses from other businesses unfair practices, penalize erring or any entities which are doing wrong for or take them to task for any wrongdoing, that will be Competition Commission of India. Its main purpose is to ensure that no monopolies are created through acquisitions and mergers. Then it will be 97. Which of the following organization regulates the cooperative banks and regional rural banks in India? Alright, NABARD, National Bank for Agriculture and Rural Development. Next, all other banks are regulated by Reserve Bank of India. In fact, sometimes RBI also funds our NABARD. But remember, RBI is a non-funding institution, despite it makes the funding. Where can the first appeal against SEBI be made? Securities Appellate Tribunal. And after you lose it, then you can go to the High Court, and then after you can go back to the Supreme Court. Which of the following is a direct beneficiary of IFCI? So that will be agro-based, service industry, capital, all of the above. But IFCI has been excluded from your syllabus, so you can eliminate this particular question. A series of payments of an equal amount, fixed intervals for a specified period of time is defined as obviously annuity. Right. So you may have faced some difficulty in business and commercial knowledge, but don't worry. There will be a lot of commonsensical questions. Even if you solve 10,000 questions related to business and commercial knowledge, still they can make so many questions for common sense that you have to answer through common sense. That will come only through practice. Alright, so read the class notes, read the handout that I've given you, go through the quick revision note that you must have received by now, and very soon you'll be given another mock test, so we'll be having a discussion on the same as well. Alright, I hope every question was clear to you. Alright, see you, bye bye, take care.